The trade that will embarrass you is not always the one you lose on. Sometimes it is the one you were right about, entered well, watched move in your favor, and still managed badly because you could not decide whether to take something off or let the position do its work. That is a quieter kind of mistake. It does not feel reckless while it is happening. It feels responsible. You tell yourself you are protecting profit or showing patience or respecting the chart. But underneath those respectable words, there may be fear pulling the hand toward the sell button or greed tying it behind your back. The market does not care which emotion sounds wiser. Scaling out and holding are both useful. That is what makes the decision difficult. A trader can destroy a good campaign by cutting it into pieces too soon, just as easily as he can ruin it by refusing to reduce exposure when the character of the move has changed. One error comes from impatience. The other comes from attachment. Both are expensive because both interfere with the same thing, judgment. You must learn to notice what the position is telling you before you listen to what the profit is doing to your nerves. A strong trade does not merely go up after you buy it. It confirms itself. It absorbs selling. It holds key levels when it should. It advances without needing constant rescue from hope. A weak trade often gives you just enough profit to make you loyal, then starts behaving differently. The danger is that your memory of the entry can become stronger than your reading of the present tape. When price moves in your favor, the question is not simply, how much have I made? That question is too small. The better question is, has the reason for the trade expanded, remained intact, or begun to decay? If the reason has expanded, reducing too much may be a tax on fear. If the reason has decayed, holding may be nothing more than pride dressed as conviction. This is where many traders misread themselves. They think the hardest part is predicting direction. But after direction has been proven, a more personal test begins. Can you remain objective while profit is sitting in front of you? Can you distinguish a normal pause from a change in behavior? Can you take partial profit without mentally abandoning the trade, or hold a winner without becoming its servant? The market will not announce that moment for you. It will only leave evidence: volume, range, failed continuation, sharp rejection, quiet absorption, the way a stock acts near old resistance, the way it behaves after good news, the way it refuses to fall when it has every excuse to fall. A trader does not usually lose control at the exit because the market moved too fast. He loses control because the exit was never truly decided. The position begins to move, the numbers begin to change, and suddenly he is trying to make a clear decision in the very place where clarity is most expensive. Before the trade is entered, the mind is still relatively free. There is no open profit to protect, no red candle threatening the account, no tick-by-tick movement demanding a reaction. That is the proper time to decide what must happen if the trade works, what must happen if it hesitates, and what must happen if it fails. Once the trade is live, every undecided point becomes a negotiation. This is why a loose exit plan is often no plan at all. I will see how it acts. Sounds flexible, but it can become an invitation to improvise. Flexibility is useful only when it has boundaries. Without boundaries, the trader can call any decision intelligent after the fact. He sells early and says he respected risk. He holds too long and says he trusted the setup. The words change, but the weakness is the same. The decision was made under pressure. An exit should be built into the trade like the entry, not because the market can be controlled, but because your behavior must be controlled. You need to know where a partial exit makes sense before price reaches it. You need to know what would justify holding full size. You need to know where the trade has failed, so you are not inventing mercy for it after it turns against you. A plan does not remove uncertainty. It keeps uncertainty from ruling you. The point is not to predict every turn. That is not trading, that is fantasy. The point is to define your responses before the market tests them. If price reaches the first area where supply may appear, will you reduce size or wait for confirmation? If the trade moves quickly in your favor, will you protect part of the gain or give the position room to become something larger? If it stalls after entry, how long will you allow the idea to remain valid? These decisions do not become easier because money is on the screen. They become harder. You must also separate the exit from the account balance. A trader who watches only the open profit begins to manage the money, not the trade. He sees a gain large enough to feel worth saving, so he sells without asking whether the trade still deserves room. Or he sees a gain smaller than he wanted, so he holds even after the position has stopped behaving correctly. In both cases, the account is giving the order. The plan should give the order. A prepared exit plan gives each part of the position a job. One part may exist to reduce pressure. Another may exist to participate if the move continues. Another may be tied to the original failure point. This is not done to be clever. It is done so that one decision does not have to carry the entire weight of the trade. When every share has the same purpose, the trader is forced into an all or nothing choice. That often turns a manageable situation into a personal contest. The serious trader does not wait until the market asks the question. He answers it in advance. He knows what he will do if price gives him the ordinary move. He knows what he will do if it gives him the exceptional move. He knows what he will not do, even if the moment feels tempting. This is discipline in its practical form, not toughness, not stubbornness, but preparation. A trader can make a correct exit and still damage his long-term results. That is the quiet danger in scaling out. It feels prudent because money is taken off the table. But the market does not reward prudence by itself. It rewards a method only when the numbers behind that method are sound. Every exit changes the arithmetic of the trade. When you sell part of a position early, you reduce exposure, but you also reduce the size that remains when the move becomes meaningful. This is not good or bad by itself. It depends on the nature of the system. If the strategy produces many moderate moves and few large ones, partial profits may support the edge. But if the strategy depends on a small number of large winners to pay for many small failures, cutting too much too soon can quietly weaken the entire operation. This is where the trader must be honest with the ledger. A 1-point gain on half the position and a 5-point gain on the rest is not the same as holding the full position for the larger move. The difference may not feel important on one trade. Over 100 trades, it can decide whether the account advances or merely survives. Small reductions in winner size compound just as surely as small losses do. The mistake is to judge scaling out only by how often it feels right. A partial profit will often feel right because it produces an immediate realized gain, but expectancy is not built from feelings of correctness. It is built from average win, average loss, win rate, and position size. A trader can raise his win rate by taking profits early and still lower his total return if his average winner becomes too small. That is why a smoother experience can sometimes hide a weaker method. Think of the trade record as a distribution, not a collection of individual stories. Some trades fail quickly. Some work a little. Some move well, then return. A few may carry much farther than expected. The large winners are not common, but they often carry more weight than the ordinary trades. If you repeatedly reduce heavily before those uncommon trades have room to develop, you may be selling the very part of the distribution that was meant to pay you. This does not mean a trader should never scale out. That would be another kind of blind rule. Scaling can make sense when the first target is statistically reliable, when the remaining position still has enough size to matter, or when the strategy is designed around frequent partial realization. But it must be measured. If the first sale is too large, the rest of the trade becomes symbolic. You may still be holding, but not with enough size to affect the outcome. The practical question is simple. What does your scaling method do to your average winner? Not what did it do on the last trade. Not whether it made you feel composed. Over a meaningful sample. Does it improve the relationship between risk and reward? Does it reduce losses without starving gains? Does it preserve enough exposure for the trades that exceed the ordinary target? If the answer is not known, then the method is not yet proven. It is only a habit wearing the clothes of risk management. You should also examine the break, even point of your style. A trader who takes small profits must be right often. A trader who holds for larger gains can be wrong more often, but but only if the larger gains are allowed to remain large. When you scale out, you are moving between these two worlds. You are changing the demands placed on your win rate and your payoff ratio. If you do not know how those demands change, you may be asking your strategy to do something it was never built to do. The numbers teach a severe lesson. Comfort and expectancy are not always partners. A method can calm the trader while weakening the account. Another method can feel less comfortable while producing better long-term results. The serious trader does not choose between scaling and holding by preference alone. He studies what each choice does to the whole series of trades. A profit on the screen does not tell you what kind of move you are in. It only tells you that price has traveled away from your entry. The real question is whether the move is being supported, resisted, absorbed, or exhausted. A trader who cannot tell the difference will often treat every winner the same, even though the market is giving very different instructions. A strong move has behavior behind it. It does not simply rise. It rises in a way that shows demand is willing to pay higher prices. The advances tend to carry range. The pullbacks tend to become controlled. Former resistance begins to act like support. Sellers appear, but they do not gain much ground. When price is pressed down and quickly recovers, the market is telling you that supply is being met. That kind of behavior argues for patience, because the move is still being sponsored. A weaker move has a different character. It may still show profit, but the progress becomes laborious. Breakouts fail to hold. Each push higher requires more effort and produces less distance. Candles may widen in the wrong direction. Volume may appear on rejection rather than continuation. The trade is still green, but the behavior has changed. This is where the careless trader confuses profit with strength. Profit is a result. Strength is a condition. You must learn to watch how price behaves at places where decisions are likely to be made. Old highs, prior breakdown levels, opening ranges, moving averages, volume shelves, and obvious round numbers often reveal the quality of the move. If price reaches resistance and pauses in a tight, orderly manner, that is different from reaching resistance and being struck down with force. One suggests supply is being worked through. The other suggests supply has control, at least for the moment. The same is true after news, earnings, or a broad market push. A weak instrument may rise because everything is rising. A strong instrument shows itself when the easy reason to rise has passed, and it still refuses to give back ground. Watch what happens after the first reaction. Does price hold the gain, or does it immediately surrender it? Does the market accept the new level or reject it? Acceptance is quiet evidence. Rejection is loud evidence. Pullbacks are especially important because they reveal whether holders are confident or anxious. In a healthy move, a pullback often comes on lighter pressure, finds support above the prior trouble area, and resumes without needing a dramatic rescue. In a tired move, the pullback cuts too deep, recovery lacks force, and the next advance cannot clear the prior high with conviction. The difference matters because a normal pause can reward patience, while a change in character punishes stubbornness. You should also notice failed selling. Sometimes the market gives the clearest signal not by rising powerfully, but by refusing to fall when it has reason to fall. Bad news comes and price holds. A sharp intraday break appears and is reclaimed. Sellers press the tape, but cannot extend the damage. This kind of action tells you that supply may already be spent. A trade that withstands pressure often deserves more respect than one that only looks strong in a clean advance. But evidence must be weighed in sequence. One strong candle does not make a trend. One rejection does not end a campaign. What matters is the developing character of the move. Is price making progress with less struggle or more? Are pullbacks being absorbed, or are they growing more violent? Are buyers defending higher levels, or are they retreating step by step? The market speaks in behavior repeated over time. This is the practical discipline. Do not ask the trade to be what you want it to be. Ask what it is becoming. If the structure is improving, holding may be justified. If the structure is deteriorating, reducing exposure may be justified. If the structure is mixed, the decision becomes more delicate, because the market has not given one clean answer. The market rarely gives the trader a perfect answer, at the exact moment he wants one. More often, it gives him a mixture, some evidence that says stay, some evidence that says reduce, and enough uncertainty to make either choice defensible after the fact. This is where the careless trader waits for certainty, and the serious trader works with classification. A scale or hold decision should not begin with a feeling and then search for evidence to defend it. It should begin by asking what state the trade is now in. Is the original idea still intact? Has the trade improved since entry? Has it weakened without fully failing? Or has the reason for being in the position disappeared? These are not emotional questions. They are sorting questions. They put the trade into a category before they ask for action. When the trade is working and the reason for entry has become stronger, the decision is different from when the trade is merely profitable. A position can be up money and still offer no fresh confirmation. It can also be up money and show that the original idea is now being accepted by the market. Those two conditions should not receive the same response. If the thesis has expanded, reducing too aggressively can be a poor decision. If the thesis has only survived, not improved, full patience may require more proof. The middle state is the most difficult. The trade has not failed, but it is no longer clean. The advance slows. The reaction becomes less orderly. A level that should have held is tested too often. Yet the central reason for the trade remains alive. This is where the trader needs a decision tree, not a debate. When evidence is mixed, reducing some exposure can buy time without abandoning the idea. It recognizes uncertainty without surrendering to it. There is discipline in partial action. A trader does not have to treat every uncertain moment as an all or nothing verdict. Holding full size says the evidence remains strong enough to deserve full risk. Exiting completely says the trade no longer deserves capital. Scaling says the evidence has changed enough to reduce commitment, but not enough to close the case. Each action should mean something. If the action has no meaning, it is only motion. The danger is that a trader often changes the question without noticing. He begins by asking, "Is this still a good trade?" Then, under pressure, he starts asking, "Can I tolerate what happens next?" Those are not the same question. The first concerns evidence. The second concerns personal capacity. When the question changes, the answer becomes unreliable. A decision tree keeps the trader from drifting. It forces him back to the condition of the trade. A useful framework is simple. If the reason for the trade is broken, exit. If the reason is intact but the behavior has weakened, reduce. If the reason is intact and behavior continues to confirm it, hold. If the evidence is unclear, do less, not more. Do not add certainty that the market has not earned. Do not punish a trade that has not failed. Do not reward a trade that is only surviving on old logic. This kind of decision-making protects the trader from two quiet errors. The first is overreacting to every change and cutting good trades into pieces. The second is underreacting to deterioration and turning a winner into a hope position. Both errors come from treating all uncertainty the same, but uncertainty has degrees. Some uncertainty is normal noise. Some is early warning. Some is the beginning of failure. The trader's work is to classify it before acting. You must also accept that a good decision can still lead to an imperfect result. You may reduce, and the trade may continue higher. You may hold, and the trade may pull back. That does not prove the decision was wrong. The decision is judged by the information available when it was made, not by the market's next move after it. If you judge every decision only by the immediate outcome, you will train yourself to chase luck instead of process. A trader will often remember the entry with great detail and the exit with convenient fog. He can explain why he bought, where the setup formed, what he saw before the move began. But when asked why he reduced size, why he held too long, or why he sold where he did, the answer becomes less precise. That is not a small weakness. It is where much of the money disappears. Entries attract study because they feel like the beginning of the victory. The chart is clean, the idea is fresh, and the trader can point to the setup with confidence. Exits are harder to study because they reveal the trader under pressure. They show whether the original plan was followed, whether the market evidence was read correctly, and whether the action taken matched the condition of the trade. If the exit is not reviewed, the same mistake can keep returning under different names. You should not review a trade only by asking whether it made money. That is too crude. A profitable exit can still be poor, and a losing exit can still be correct. The real question is whether the exit was faithful to the trade as it developed. Did you sell because the reason for holding had changed, or because the open gain looked too good to risk? Did you hold because the trade was still acting properly, or because you did not want to admit the best moment had passed? A journal must force these distinctions into the open. The useful review begins with evidence, not opinion. Save the charted entry. Save it at the first place you considered scaling. Save it at the moment you acted. Save it after the trade was finished. When those images are placed side by side, the story becomes harder to decorate. You can see whether the exit came near resistance, after a failed continuation, during normal consolidation, or in the middle of ordinary noise. The chart keeps a colder memory than the trader. Then compare the planned exit with the actual exit. This is where professional growth begins. If you plan to take partial profit at a certain area but acted earlier, write down what changed. If nothing changed except the movement of your account balance, mark it plainly. If you plan to hold through a normal pullback but reduced during the first pause, note the difference. The purpose is not to scold yourself. The purpose is to find the gap between your method and your behavior. Over time, these reviews expose patterns that a single trade can hide. You may discover that you sell strong trades too soon after the first quick move. You may find that you hold fading trades after they fail to continue. You may see that you follow the plan well in small positions, but abandon it in larger ones. These are not random incidents. They are habits, and habits cannot be corrected until they are named. A serious trader also records the reason for each exit in simple language. Not a long story, not a defense. 1 or 2 clear sentences. Reduced because price rejected the prior high, held because pullback stayed orderly, exited because the original level failed. This practice trains the mind to connect action with evidence. When action has to be explained afterward, weak decisions become visible. Good decisions become repeatable. The review should also separate process from outcome. If you sold according to your rules and the market later continued without you, the review may show a sound decision with an unfortunate result. If you broke your rules and made money, the review may show a dangerous reward. Without this separation, the trader becomes educated by accident. He repeats what recently paid him, even if it was poor practice. This habit is not glamorous. It will not give the immediate satisfaction of finding a new setup. But it is one of the quiet marks of a professional approach. The trader who studies only entries is always hunting. The trader who studies exits is learning how he actually handles opportunity. He is no longer asking only, "Where could I have bought?" He is asking, "How did I behave once the market gave me a chance?" A trade is not the same thing at every stage of its life. The position you enter is an idea under test. The position that moves in your favor is an idea beginning to prove itself. The position that extends far from entry is no longer just an opportunity, it is also accumulated risk. If you manage all 3 stages the same way, you are treating a living thing as though it were fixed. At entry, the trade has not earned trust. It only has a reason. Your first responsibility is to define how much capital you are willing to risk, while the market decides whether that reason has merit. At this stage, size must be controlled because the trade has not yet produced evidence. A trader who gives full confidence to an unproven position is not managing a trade. He is making the market prove him wrong before he respects danger. Once the trade begins to work, the nature of the problem changes. The question is no longer only, "Where am I wrong?" It becomes, "How do I protect the position without suffocating it?" This is where trade management begins in earnest. If you move protection too close, ordinary movement can remove you before the trade has matured. If you leave risk completely unchanged after the market has rewarded the idea, you may be allowing an earned advantage to remain exposed unnecessarily. The position should be managed in layers. One layer concerns risk, one concerns profit, one concerns opportunity. When price confirms the idea, the risk layer may need to shrink, That can happen through a stop adjustment, a partial sale, or a reduction of exposure at a logical point, but the opportunity layer must remain alive if the trade still has room. The purpose of management is not simply to avoid loss. It is to keep the right amount of capital attached to the right amount of evidence. A common weakness is to manage the whole position as one block. Full size in, full size out. Sometimes that is appropriate, but often it makes the decision heavier than it needs to be. When the entire trade has one exit, every adjustment becomes a verdict. You are either loyal or finished. But a position can be shaped. Part of it can pay for the risk taken. Part of it can remain with the larger move. Part of it can be governed by a trailing level or a prior structure. Each piece should serve a purpose, not an emotion. As the trade advances, the stop should not be moved merely because time has passed or profit has appeared. It should be moved because the market has created a new place where the trade should not return if it remains healthy. That distinction matters. A stop placed too tightly around profit is usually a claim that the market must move smoothly. Markets rarely honor that claim. A stop placed beneath a meaningful new level says something different. If price breaks back through this area, the character of the trade has changed. The same applies to partial exits. A partial exit should not be a random reward. It should answer a practical condition. Has price reached an area where reaction is likely? Has the distance from entry become large compared with the original risk? Has the position grown too exposed relative to the evidence now available? When a sale answers a condition, it becomes management. When it answers only the desire to feel finished, it becomes interference. Holding period must also evolve. Some trades reveal quickly that they are short-lived. They give the expected move and begin to lose momentum. Other trades broaden in quality as they develop. They hold levels, attract participation, and continue to offer favorable structure. A trader who decides in advance that every trade must be short or every winner must become a campaign refuses to listen after entry. Duration should be earned by behavior. Your task is to keep adjusting the commitment to the quality of the trade. More evidence can justify more patience. Less evidence can justify less exposure. No evidence should not justify stubbornness. This is the practical middle ground between grabbing at profit and blindly holding. The trade is neither sacred nor disposable. It is managed according to what it continues to deserve. One of the most dangerous mistakes in trading is not open recklessness. It is the mistake that looks disciplined from the outside. The trader follows a rule, repeats a phrase, keeps a firm face, and believes he is acting with control. But a rule can become a hiding place when it is used to avoid thinking. There are two false forms of discipline that appear again and again. The first is taking profit too quickly and calling it prudence. The second is refusing to take profit and calling it conviction. Both can sound respectable. Both can even work for a while. But when either becomes automatic, the trader is no longer managing the trade. He is protecting himself from the difficulty of judgment. The quick profit trader often believes he is being sensible because he does not let winners turn into losers. That sounds clean. The trouble begins when he treats every open gain as something fragile, no matter how well the trade is behaving. He sells because the position is green, not because the opportunity has weakened. Over time, this trains him to distrust success. The market gives him a good entry, a favorable move, and improving conditions, but his habit removes him before the trade has had a chance to become important. The other trader makes the opposite error. He believes selling is weakness. He tells himself that strong hands do not flinch, so he holds through every warning, every failed push, every clear change in tone, because he has confused patience with loyalty. A trade does not deserve loyalty, it deserves observation. When holding becomes a matter of identity, the trader stops seeing the position as capital at risk and starts seeing it as a personal statement. Another common mistake is moving the target after the trade is already in motion. Before entry, the trader wants a reasonable gain. Once price moves in his favor, the target becomes larger, then larger again. This is not always ambition. Often it is simply the refusal to make a decision. By moving the finish line, he postpones the burden of choosing. The market may reward him once or twice for doing this, and that makes the habit harder to correct. A lucky escape can educate a trader in the wrong direction. There is also the mistake of selling because the profit has reached a number that feels satisfying. The trader sees an amount he does not want to lose, and that number begins to speak louder than the trade itself. He may tell himself he is locking in a good day, but the market does not know his daily goal. It does not know what amount feels meaningful to him. When a trader exits because the profit looks emotionally complete, he is no longer responding to the position. He is responding to his own accounting. The same problem appears in reverse when the profit is smaller than expected. A trader may refuse to scale out because the gain does not feel big enough yet, even though the trade is beginning to stall. He waits for the market to pay the amount he imagined, but markets do not owe the trader symmetry between expectation and outcome. When evidence weakens and the trader still waits for a preferred number, he has turned a live decision into a demand. A quieter mistake is treating every winner the same. Some trades deserve to be harvested quickly. Some deserve time. Some deserve reduction but not abandonment.